So welcome aboard again. So we're still on this Amazon versus Jumia um, comparison. So apart from the disparities that are obvious in terms of revenues, it's been established already that Amazon is now profitable. They've been profitable essentially for since 2003, plus some little blurb along the way, and Jumia is still not profitable. Well, that is actually not the point. The point really is that um, the problem is not that Jumia is not profitable. The problem is about understanding what are the fundamentals that actually drive this lack of profitability and lack of potential sustainability. These things are fundamental drivers or levers that are within the system. We can look at this. People would say, oh, but Amazon was also not profitable until 2003. Actually, that is true. This chart actually shows us Amazon's quarterly net profit. They started in 94, and until about 2003, they couldn't declare even a quarterly profit. But then ever since, apart from some blurb that happened in 2011 stroke 12, all the way to 2013, 14, they've actually had a forward moving trajectory in terms of profitability. So, one of the things people need to understand was in those days when Amazon was not profitable, over those 10 years, they were actually building capabilities. They were building the asset base. They were building the structural foundations that are required to run this kind of business effectively. How do I mean? So let's look at the revenue basis. For example, if you look at Jumia, um, the revenue sources essentially come from what they call marketplace revenue, which we would refer to as third-party revenues. These revenues, they are basically the kind of revenues that you get from commissions on sales. So this is you're selling someone else's products. You're not selling your own widgets. You're selling on behalf of somebody else, but you're taking a commission. It could be a certain percentage of the total sales value of that item that you're selling on behalf of a vendor. And then you have fulfillment costs, which are all costs that have to do with the receive, the pick, the pack, the ship, the all the processes that are involved in making sure that the item gets to the customer, as well as making some money from marketing and advertising from people who come who are like the vendors who run businesses on the Jumia platform and who are making sales. And then you've got value added services, which is another sort of stream of income that Jumia has embraced. Um, However, they also have what they call the first party revenues, which are the revenues that they derive from their own sales, which is these items belong to them. They were in their own inventory, in the balance sheet of their own companies, and they're selling this produce or these products to customers, which means they are the customer. So pretty much, sorry, they are the supplier of interest in this case, and they are the ones that are actually making the sale and declaring the revenue. So all of the sales actually come to them, and you can see the fact that the marketplace revenues are actually a whole lot smaller than the first party revenues. That reflects in the fact that for marketplace you're getting only a percentage of the total sales value, but for first party revenues you're getting the whole chunk. All of the price multiplied by the total quantity of the items you sell actually come to you. When they put both first party revenues and marketplace revenues together, they get to what they call the platform revenues, which is a combination of both of them. Um, and then you've got non-platform revenues, which are also, other revenue streams that they have. The whole idea of looking at this is to actually read that statement that they have at the bottom there, which says that marketplace revenues increased by 69.9% from that number in 2018 to that number in 2019. And this is driven by strong increases in commissions and fulfillment, etc. So this is the marketplace revenues for them is growing at about 70%. If you read the next statement that says in 2019, we placed particular emphasis on building out and growing our marketplace, our marketing and advertising revenues, which is a component of the marketplace revenues. And that basically increased by 169% from 2.3 million euros in 2018 to 6.1 million euros in 2019. So the focus for Jumia, and this is also something you read in the article, in that Harvard Business Review article, or Harvard business case that has been shared, is that what you'd see is that actually Jumia started focusing on marketplace from 2016, and this is their own growth channel. Now, first party sales for them has become pretty much like a cash cow. It's become like a slow growth area. You can even see that there was a decline in growth from 2018 to 2019 in the last statement. So contributions from sales of goods, that is revenues from first party sales, remained nearly unchanged. It actually pretty much declined by some percentages. But when you look at Amazon and you look at the revenues that their composition, the composition of Amazon's revenues, you'd see that online store sales are actually the most dominant sales, pretty much similar to what you had with Jumia, with first party sales being higher. Um, Third party seller services for Amazon as well is actually also pretty decent. When you look at the numbers for 2019, is about $54 billion. But when you go in there and you go and essentially read some of the components of the sales, you really understand that actually online sales is the equivalent of first party sales for Jumia, and third party sales, seller services for Amazon is the equivalent of third party sales for Jumia. But there is a black swan, pretty much like a hidden um, a growth area that most people did not expect, which is the AWS that has come in and has actually been growing super fast for Amazon over the years. It's currently now at 2019 generated about $35 billion. It's really interesting to have a look at this and to understand the structure by which these companies operate. Um, so when you get into looking at Amazon's revenues, you would see that online store sales were growing by about 14.8%. For Jumia, online store sales, which are first-party revenues, declined by 0.123%, thus confirming the strategic shift for Jumia from e-retail to marketplace in 2016. For third-party sales for Amazon, you had a growth rate of about 26%, which is a lot higher than first-party sales. Even though it has a much lower base, the total absolute value is actually lower. But for Jumia, you've got about 70% growth in the third-party sales. For Amazon, you've got the AWS that's growing at about 36%, and that's actually Amazon's fastest growing area. So you probably would have heard about the fact that Jumia now wants to start focusing on growing its Jumia Pay strategy, which is to open up its payments platform, become like a Paystack or become like a Flutterwave, and actually open up that ecosystem for a large number of other vendors to start using, or a large number of other businesses to start using. Um, you could understand this to be the what they call the portfolio strategy. So there's a matrix that came out that BCG, which is one of the large management consulting firms in the world, has put together regarding what they call it the BCG matrix. And on the horizontal axis, you've got relative market share, which could be high market share or low market share. When you want to have high market share, if you have high market share in any sector, you're going to be generating a lot of cash. That's basically the assumption. And on the vertical axis, you've got the market growth rate, which is actually that if the market is not growing very fast, you're going to be using a lot of cash. You're going to be using less cash than if a market is growing a whole lot, which means you're going to be using a lot of cash. You would see, for example, that for Amazon, the star product is actually AWS. It's generating a lot of cash, but it's also using a lot of cash. So they have to start investing a lot in building the technology infrastructure, getting a lot of servers, making sure that they have the capacity to be able to onboard a large number of small businesses who want to use the AWS infrastructure, or a large number of startups who want to go AWS. You would have heard, if you're in the startup space, a large number of startups, even across Nigeria, are now deploying their technologies through the AWS infrastructure. So essentially, that help the fact that they have to use a lot of cash for that, but potentially that is also a space that is also generating a lot of cash, because then the cost basis of that, the outflow of that is actually a whole lot lower than the inflow that's coming in. So it's an area that is driving a lot of growth. So there's a lot of improvement there. For Amazon as well, the e-commerce is actually a cash generating engine. So that's why you have the cash cow there. So they play basically on those two sides of that portfolio, which is you have the star product, which is AWS, and then you have the cash cow, which is essentially your e-commerce platform. This platform is using very little cash, but it's generating a lot of cash. How does it generate that cash? It's generating that cash basically because of unearned revenues, which are the payments that customers pay them ahead, and we're going to look at that as we go on. It's also generating a lot of cash because the rate of the transactions that are going through those platforms are so huge that they can essentially afford to start making a lot of cash, using that cash to invest in the AWS infrastructure, and then cashing out even before they deliver the items to the customers. So when you look at Amazon versus Jumia in terms of their balance sheet, and this is where you get a whole lot of value. Some of the things that come out to me are the fact that on Amazon's balance sheet, you've got inventories. In 2019, they had about $20 billion worth of inventory. This is actually items that they have on sale that are owned by them. This is huge. You also see property, plant, and equipment. These are assets, hard assets in terms of warehouse infrastructure, in terms of of servers, in terms of network spaces, in terms of tech products and facilities and units, in terms of equipment and conveyor belts and robots, etc., worth about $72 billion. This is huge. This actually is a moat. Asset is a moat. We're going to discuss that a lot when we keep going into the construct. And you would see also for Amazon on-end revenues of about $8.2 billion. So imagine you're being financed by your customers to the tune of $8.2 billion. This is huge. It's humongous. And this is cash that is available for you to deploy into whatever it is that you want to do. So when you look at their cash and cash equivalent space, and you can see $36 billion for 2019, all of this come from the fact that they've structured the business to be a cash generating engine. When you look at the balance sheet for Jumia on the other hand, you see property, plant, and equipment for 2019 of about 17.4 million euros. You would see also inventory of about 10 million euros. You would also see cash and cash equivalents, which is pretty good, of about 170 million euros. If you look at their unearned revenues, which they call deferred income, it's about 6 million euros, just all the way down there at the liability side. This is actually decent for their kind of space, but it doesn't really tell us the full story. We don't really see the full picture yet. So what I'm going to do is over the next session, we're going to have a look at a video. And this is actually a super interesting video where you would watch the story of a very popular retail company, a quick service restaurant business in the United States. And you would see that started in the United States and has spread across the world now. You would see something in that video. Watch out for minute 1 and the 20th second after that. It's going to be super interesting for us to really understand what's really going on in the retail space. Thank you very much.